ICA. Welcome back, you guys. Now that we've done the first two lessons where we went over our averages, standard deviation, we've gone over percentages, compound interest, and a little bit of risk to reward. And now we're going to go into some basics in terms of supply and demand. All right. Now, I know not everybody's taken an economics class. That was actually what I studied as my minor at UCSD. But one of the most basic teachings that you're ever going to learn for supply and demand is something you can actually envision and imagine when it comes down to your own life and the items and the products that you may use. So whether you want to think of this as something that you eat, it could be the food at the supermarket. You can think of supply and demand as the products that you like to buy in terms of shoes or iPhones or things that are commonly used. So put your mind to one of these things. I'm going to stick to the iPhone or Jordans, for example, and we're going to talk a little bit about how supply and demand. The main thing to start off with is this main chart in the middle. You just have supply and demand that cross, right? Demand is a line, supply is a line. The idea is that as a producer or somebody that controls the prices of making these, as you create more quantity, the price starts to go up. Okay, you're going to make more of them. But demand is this line that is going to be determined, by your marketing, all these other things. But wherever they cross gives you price and quantity of the market. Okay. Now, when things change, when demand changes, that's what the left side says, you can think of as fewer buyers come to the market, then demand is going to decrease or go downward, right? As a result, this line here is going to slide further and further down when fewer buyers are at the market. While there's more buyers, that would lead it to go further up, okay? And what you'll notice is where we are now fewer buyers will decrease the price, while more buyers will increase the price. That makes sense, right? If the iPhone can't be sold at the price it's at, $1,000, let's just say, for that model, then eventually, if demand keeps on dropping, people don't want it anymore, they start to lower the price and they sell fewer of them, but because that demand has decreased, okay? On the right side here, quantity will increase and price will increase if we have more buyers. So that's what's going to happen if the demand changes. Now, if you notice here, price is going up when there's more buyers and also when there are fewer sellers too. So what you can imagine is demand can think of as the buyers, supply, or you can think of, Apple's got a certain amount of supply at the market. If they decide to add more to it, or suddenly everybody who's using their iPhones all of a sudden decide to go bring it back to the market, well, that's changing this line on the right, okay? Actually I have this already drawn here. Supply, in this situation, if sellers start to increase the quantity, right, that actually decreases the price. Does that make sense? And here, if supply increases, okay, goes up, or as a result, sellers' supply decreases, there's fewer people selling, that's where the price is going to increase. Just so you guys have it, here's the drawing of all of it together, just to remind you guys, right? Demand lower or demand higher, higher prices, lower prices. Over here, supply going higher, meaning more sellers, price goes down. Supply or sellers leaving, not as many ready to sell, price goes up. Okay. And you can think of it too, the bottom right situation here, you can imagine fewer sellers when something new comes out and the supply gets taken up. So the new Jordans come out, some new Louis Vuitton bag comes out, or the newest iPhone comes out, and everybody decides to pick it up and they don't want to get rid of it because they're using it. Well, that price goes up, right? People are willing to pay a little bit more because there's fewer of them to go around to pick up. All right, so that's the main idea between supply and demand. Now, this whole thing should be kind of in the back of your mind, but what's most important for us in the marketplace is just this. The top that I've got here is when prices go up, that's when many people want to buy. So the demand goes up and the supply goes down. So you can think of them working in conjunction. Then on the other side, when prices go down, that's when a lot of people want to sell, right? The supply has gone up, right? You can see how these are going to be opposites of each other and opposites of each other. Demand goes down. All right, so with that being said, you can always consider how our prices are going to be charted, how they're going to be put into data for us to understand. Now realize that a line graph is going to be the most simple. For example, here on the right, what I've got is the price history of, what was this one? I think it was a pair of Jordans, okay? And the price history of it is just a simple line graph because what they're doing is, like we've said before, they're taking a moving average, right? They're calculating our averages and standard deviations like we're used to from before. And instead of charting them out in a candle-like format, they've used a line graph. Line graphs make the most sense for the majority of people. However, when you look at this with a line graph, you're technically losing quite a bit of data, right? And that's where these candlesticks come into play. Candlesticks are designed in a very particular manner that help you understand that at any given time point, there's actually more than just that average price that's being displayed. There's actually going to be a range of people's prices, right? A range of it, and that dot very likely is going to be somewhere in the middle. So for example, on that day, that dot could be anywhere along this candle wick of this candle that we've drawn here. But what a candle shows is an entry point, an exit point, and a full range of prices that people were willing to pay in a time frame. Now, that's where we're going to tell you guys we're going to be using candles in all of our charting because it ultimately gives us more information. That way we can consider where the buyers and sellers, where the supply and demand happen to stand on the graph. And the candlestick is going to give you the additional of the range readings, not just the mean of a line graph, okay? When we start off, it's not terrible to look at line graphs, but as you start to do your charting, as you start to look at the actual price movement, the candlestick graph is where you want to chart because that's going to give you the full picture as to what's happened. The mean, right? For example, if I just told you the average for Steph Curry, right? That number only means so much. His average this year is 25 points. Okay, great. But what if you could get the information of, yes, his average is 25 points, but also for this season, he's had a low end of his point total. Let's say the lowest he scored was 10 points, and then the highest he scored was 53. Okay. Then when you look at different years, you actually get to compare the highest that he scored, the lowest that he scored, and get a better idea of the ranges he's had for that season. And as a result, it's going to give you more data to judge upon his performance. And that's the same idea with these marketplaces and these price charts of different tickers and any sort of commodity as well that you might be able to purchase. We want more information. We want to understand a couple more points in the chart. Okay, so candlesticks will come in two colors. You've got your green and you've got your red. If your candlesticks that you're looking at aren't set up in this way, there's a way under your settings where you can go change them. So going up is green, going down is red. That's simple enough because the body of the candlestick, this big box that exists, shows whether you enter down and exit high, or if you enter high and exit low, right? Red means we had downward movement in the body. Green means we had upward movement in the body. Then the wicks are going to show you where the highs and the lows of that time frame are. Now, remember when we talked about the marble jar, these candlesticks can be depicted in many different time frames and formats. What that means is something can be charted out as an app, like for example, a larger time frame of Apple here of 1 month candles. Each one of these candles comprises of a full month of time. Then when you go ahead and you break it down into something like the week or the day, which are smaller candlesticks, they still have the same amount of data, but they're more so compressed, okay? The first couple weeks here are going to, right, if you think about it, 5 of these candles equals 1 of these weekly ones. 4 to 4.5 of these weeks is going to equal 1 of these month candles. And so it's a way of compressing the data. Now, we always will keep you guys and tell you guys, start from what we say top down. We start with a monthly, weekly, daily. Those are where we want you to start your charting from. The most important one is going to be that daily, okay, that we are looking at, because it will help us set up the inter time frames, the in-betweens, in terms of these smaller time frames that we will start to chart at eventually. But for now, the two focus start with weekly and daily. Those are where we're going to focus our attention to. With that being said, let's go straight into our charts. And what you can see here, okay, if you're on TradingView, you do have the option of choosing a couple of different setups for your candle. Now, the ones that we have you do here are just regular candles. You also have your line graphs. A lot of these are different ways of charting the same thing, but I want you to avoid hollow candles. Hollow candles change the red and green to mean a little bit different of a thing. It's just relative time frame, relative prices. But candles here are important for us to understand, give us that green and red to tell us up or downward movement on that day. Now this should make a little bit more sense. So if I were to really, right, let's expand this a little bit. Let me kind of give you an idea of how this price is moving. Because, for example, let's start right here. Okay, this green candle. We started down here, bounced up there, and eventually ended up here. Now, it could have come back down and messed around, but the goal to understand is low, high, and exit point. Then the next day it dropped, opened up here, came all the way down, and then came back up to this point, right? So these candles actually show us, quite a bit of information in here, right? Let me give you on right here what we're looking at here, and we'll draw something out, and we're gonna compare it when we get a little bit closer. So right here, I'm just gonna go with these couple candles in green. That way, when we expand them, we'll see them. And the idea here, we'll do a path. We enter here and we exit here. Does that make sense? But we go as high and as far down low as this before we exit. Then this green one, we go as high and we go as far down here before we exit on the right here. We open up here, go as high as here, go as far down as here before we exit here. Enter, up, down, exit. Okay, so if you kind of look at that, I've just plotted these out from the green. We're going to go a little bit closer. We're going to go into an hour chart, and whatever's in green, right? See that? Is going to give us an idea of how this had moved, right? We started up over here, went as far down as here, which is true, right? And we exited into the next part right here, which is true. We went as high as this, okay, as low as this before we exited and went to the next block. So do you see how my daily candles now split up into a couple of hourly candles here, 1, 2, 3, 4, 5, 6, 7, 8 hours, or 7 to 8 hours within the day, because you have this one that kind of overlaps that 30-minute mark. Okay, so these candlesticks, it takes a little bit of time to understand what's going on with these. But one thing I will point out is that candlesticks give you much more information. So for example, if I'm just staring at this point in time right now, candlesticks give you a better idea of how supply and demand are playing out in the market. Now, what does that mean, Eric? Well, what that means here is there are going to be trend lines that exist. One, for example, is this downward trajectory trend line here, where buyers and sellers will put themselves in a position to potentially purchase when it gets to those ranges, right? Now, it's not always going to be 100% perfect, but what you can imagine is it's people waiting around for price to hit a certain level. And you have two ways to chart your supply and demand. You have your horizontal lines. So you have horizontal line, horizontal ray. I like the ray because it kind of lets me point out exactly where things are at and where it reads over. But when you see these large reversal areas, what you can imagine here is that suddenly price moved away because there was an imbalance of supply and demand. In those situations, you got to imagine that those people are either invested in here or they need to get themselves out if the price ever comes back to those ranges. So the places in which price dives away from significantly and moves away from significantly, those are areas and ranges where we start to believe and start to think of as where lots of buyers and sellers happen to stand. And wherever it does revert here, I think, hey, there's a lot of sellers at this point. If it ever comes back up to this point, we should be ready to sell because they're trying to get out here. As well, on the other side, on the bottom side, you can imagine these are areas of demand. Don't necessarily think of it as just, the SPY or SPX here. Think of it as something that's actually worth, in this case, we say $360, right? Well, something that's been going for about 400, when it comes down to 360, are there going to be people in the marketplace ready to snatch it up? In this situation, it's actually very likely, right? I know I took off a couple zeros, but if it comes down to this price level right down here, the previous actions and the previous buyers and sellers actually stepped in heavily. All the demand came back in down here and pushed it all the way back up. So if price did ever come back down to there, that's where you're looking to potentially get into a call of that type of bounce if the price comes back down to this area, simply because you do believe, hey, there's buyers and sellers there. In addition, we're gonna add one quick little thing, VRVP, this visible range volume profile, is where I can take this entire chart. Let me just clear this real quick. And what it'll do is it'll chart out the volume on the right. In a lot of circles, in a lot of different charting services and brokerages, what they usually will give you is this this volume on the bottom. This is the time charted volume. Okay, a time charted volume. I also put a moving average with it. But if I didn't, what you can see is it's all these different spikes and different volume readings of buyers and sellers. Okay, it's a total volume. So if this was the price of iPhones, down here tells me the number of iPhones that are being bought and sold, and the color of it tells me whether price went up or down. And as a result, you can see, right? For example, I can see here, there's a lot of buyers and sellers in this range, okay? Which also does mean if price ever does come back down all the way down to these levels, I would expect that there's going to be some buy up. There's going to be buying pressure coming from below. There's going to be people ready to purchase, okay? Same idea too with, that's our horizontal lines that we've charted, okay? horizontal lines, but also you'll notice there are these diagonal lines that create growth trends, etc. Right? What you're trying to do when you draw these specific demand and supply lines, right? Demand comes from below, supply comes from above. And what they're looking for is when it hits that top range is where it usually is going to start to sell off from, okay? And that's the same idea with where we're at right now. If I were to give you a little more drawing of where we're at right here, we've been in this downtrend, but right now we're in a very interesting spot, okay? The idea with buyers and sellers in these resistance lines is that when they come back to those prices, people have to make a decision. Do you buy more or do you get yourself out? And very oftentimes, so for example, when a trend line is fully broken, okay, in this case, fully broken, it'll come back to retest it. If it retests and it breaks back through, we continue. But if it rejects the values, then we head away from it. So for example, you can imagine here, we bounced back up and then came down here and rejected right here before finding a new range of prices that people are willing to pay. Price is generally going to look for ranges of buyers and sellers, okay? So right now we're kind of in a bigger range right now. And these ranges, once they're broken, you know, everybody needs to agree together, hey, we're expecting higher prices here. We're expecting lower prices here, where the buyers and sellers sit, okay? Now keep in mind too, you know, marble theory or the big marble jar, these represent, you know, billions of stock purchases, okay? Billions of people buying and selling. At the end of the day, we need to understand that there's going to still be higher volume and areas where people's prices have them locked in. So instead of us charting our volume in a time manner, we can chart it in a price manner. And that's what I had here with VRVP. Regular volume is going to show you the volume. So for example, if I keep my eyes up on the top left here, the volume most recently here was about 3.2 billion traded on the day for SPX. Okay, that's a lot. All right. I want you to think of it this way in terms of, you know, law of averages, etc. Are you and I going to be able to make, you know, a purchase or a sale that's going to move these markets significantly? Do we have the buying power to do so? In most cases, you're going to say no, right? We are, you know, tiny in this market. So understand that we're here to watch the price action. We're not here to influence it ourselves. What we're looking for is to find price trends and resistances and supports and play a probability situation that gives us an idea of where price may head next. There's a lot of strategies that we'll continue to go through. There's a lot of different things we got to talk about. But in this situation with what we see, right, we've talked about averages, etc. We most recently saw that the moving averages have crossed up a little bit for a golden cross. However, what this actually shows right now is we've come back down to a trend here. We kind of are respecting it. How next week goes, I think, is going to be extremely important, whether we see a respect of this trend line and head back up, or if we see a breakdown and continuance down further. There, you know, today is March 10th of 23. And we just had news yesterday about how Silicon Valley Bank or financials had a huge crash. Let me pull that up real quick. SIVB, Silicon Valley Financial Group. Oh, this doesn't even show all of it. Let me go down into the hourly. It's not at 106, it's at $40, guys. You're not going to see that unless you pull up your extended trading hours. Basically, due to the interest raises of the Federal Reserve, they actually had some bonds that were stuck in some very low interest rate situations. I think 1.7 was what I remember reading. And as a result, they needed to take care of those low interest bonds and reposition themselves into the higher interest rates that are currently being offered. But as a result, they actually lost billions and billions of dollars. They ultimately, took in a little bit of a sense, they took a gamble. They needed to balance out their books so that they have better forward looking and better future for themselves. However, their approach was very poorly timed in the fact that there were other things such as other crypto assets that were starting to fail. So what ended up happening here was you had, right now, this is ultimately a big giant sell-off where you had it drop from almost $300 all the way down to 40 within the matter of a day and a half. The options on this were kind of ridiculous, but they're very hard to access as well. I don't want you guys to think that you guys should have gotten in onto this. We had no signals and no, essentially this was insider information that this was going to happen, because once they reported that this is what they're going to do with their, with their company, that's where the sell-off came from. They also were, in order to also balance out their books, they also had to do, they had to sell more shares too. So they brought more shares to market. And ultimately, the way I want you to think about it is the value of their company ultimately was divided by more shares, right? They brought more shares to market. They had to do an offering to raise money for their company. As a result, they offered more shares to the market, and that what that does is it takes their market capitalization, takes their value of their company, and divides it by a bigger number. So each stock is going to be worth less. So it's kind of like, in terms of this bank, it was Armageddon for them. They screwed up a couple of things, but a lot of that also had to do with the fact that we've been dealing with the raising of interest rates recently. In our next couple of sessions, we'll start to talk a little bit more about the economy and the interest rates and those types of things. That's coming up very soon. But for this session that we had, what I wanted to make sure that we understand here is supply and demand. Supply and demand ultimately will help us determine where the buyers and sellers stand on the big picture of our charts. We also have now introduced to you guys too these candles and candlesticks that help us determine where price goes and where it starts to reject from as well. This upcoming week will be very important for us to take a look at. But again, as of right now, what we've done here is price has rejected these higher levels and now is entertaining lower levels too. So we'll see how it comes, if these sellers here or these buyers here that prop the market up right here most recently, we'll have to see when we come back down to these prices whether or not they determine to purchase more or to get themselves out. There does seem to be quite a bit of heavy selling pressure, but again, the rest of the markets, the rest of the tickers that we got to talk about, we'll get and jump into that very, very soon. Keep in mind, if you guys have any questions, go ahead, pull up your Discord, go ahead, ask us questions. That's what we're here to do. I want to make sure that if you have anything that doesn't make sense in this, maybe the shoes and the iPhone thing didn't work for you, maybe we got to talk to you about coffee, maybe we got to talk to you about something that's related to your line of work. If that's the case, let me know. I'm more than happy to help you understand that to your best extent. So please don't hesitate. Let me know how I can help. But with that being said, this is Eric signing off. I will see you guys in the next one.